preparing for an investment banking analyst at EFG Hermes interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to join EFG Hermes Investment Banking as an analyst? EFG Hermes is compelling because it combines a strong regional investment banking franchise with exposure to Egypt, the GCC, and frontier markets. I'm interested in investment banking because it sits at the intersection of valuation, strategy, and execution. As an analyst, I'd expect to support pitches, financial models, diligence, and deal materials. What attracts me is the chance to advise companies through IPOs, M&A, and capital raises in markets where growth and volatility both matter. Why answering? Focus on EFG Hermes regional franchise, exposure to MENA and frontier markets, transaction execution, and why investment banking analyst work fits your skills and career goals. Question 2. How would you value a company operating in Egypt or the GCC? I would triangulate value rather than rely on one method. For a regional company, I'd use a DCF to capture its own cash flow profile, trading comps to reflect current market pricing, and precedent transactions if deal data is available. I'd normalize EBITDA, adjust for one-offs, consider currency and country risk, and test sensitivity to margins, growth, and discount rate. The final recommendation should be a defensible valuation range, not a single number. Make sure to cover DCF, trading comparables, precedent transactions, regional peer selection, currency considerations, country risk, and the importance of presenting a valuation range rather than one precise number. Question 3. Walk me through a DCF valuation. A DCF values a business based on the cash it can generate in the future. I'd project revenue, margins, taxes, working capital, and CapEx to calculate unlevered free cash flow. Then I'd discount those cash flows using WACC and add a terminal value, usually from perpetuity growth or exit multiple. After arriving at enterprise value, I'd adjust for net debt and other claims to reach equity value. Sensitivities on WACC and terminal assumptions are essential. In your answer, talk about projecting free cash flows, calculating WACC, estimating terminal value, discounting cash flows, moving from enterprise value to equity value, and sensitivity analysis. Question 4. How do you choose the right comparable companies for a valuation? The best comps are companies investors would realistically compare to the target. I'd screen for similar business model, revenue drivers, geography, size, growth profile, margins, and capital structure. In MENA, the peer set can be thin, so I may include broader emerging market or global peers, but apply judgment around liquidity, governance, and country risk. I'd calculate multiples like EV/EBITDA and PE, remove outliers, and explain why each peer is relevant or less relevant. Be sure to mention business model similarity, geography, growth, margins, scale, leverage, liquidity, listing market, accounting comparability, and why regional markets may require judgment when peers are limited. Question 5. When would precedent transactions be more useful than trading comparables? Precedent transactions are useful when I want to understand what acquirers have actually paid for similar assets, including control premiums and strategic synergies. They are especially relevant in M&A situations or when a company may be sold. The limitation is that deal data can be old, incomplete, or from a different market environment. In regional markets, disclosure may be limited, so I'd use precedents as one input alongside comps and DCF, not as a standalone answer. While answering, focus on control premium, strategic value, market cycle, deal terms, transaction availability, regional disclosure limitations, and why precedent deals often show what buyers have actually paid. Question 6. Walk me through the impact of a $10 increase in depreciation on the three financial statements. Assuming a 30% tax rate, a $10 increase in depreciation reduces pre-tax income by $10 and net income by $7. On the cash flow statement, net income is down $7, but depreciation is added back by $10, so cash flow from operations increases by $3. On the balance sheet, PP&E decreases by $10, cash increases by $3, and retained earnings decrease by $7. The balance sheet balances because assets and equity both fall by $7 net. Make sure to cover income statement impact, tax shield, net income reduction, cash flow statement add back, balance sheet changes to PP&E, retained earnings, cash, and why cash increases versus net income. Question 7. How do you move from enterprise value to equity value? Enterprise value represents the value of the operating business available to all capital providers. To get to equity value, I subtract debt, preferred stock, and minority interests, then add cash and non-operating assets such as excess investments or associates if appropriate. The basic bridge is enterprise value minus net debt and other senior claims. Once I have equity value, I divide by diluted shares outstanding to get implied share price, which is especially relevant for IPO or public market analysis. In your answer, explain that enterprise value reflects the value of operations, then adjust for net debt, minority interest, preferred stock, associates, non-operating assets, and cash. Question 8. What makes an acquisition accretive or dilutive to EPS? An acquisition is accretive if the buyer's pro forma EPS increases after the deal, and dilutive if EPS decreases. The key drivers are the target's earnings, purchase price, financing mix, cost of debt, lost interest on cash, new shares issued, synergies, and transaction costs. For example, cheap debt financing and strong target earnings can make a deal accretive. But accretion does not automatically mean value creation. I'd also look at ROIC versus WACC and strategic fit. Be sure to mention purchase price, financing mix, target earnings, cost of debt, lost interest on cash, share issuance, synergies, integration costs, and why accretion alone does not prove value creation. Question 9. What are the key steps in an IPO process? An IPO starts with readiness work, financial cleanup, governance, auditor comfort, and selecting advisors. The bank then helps develop the equity story, valuation, prospectus, due diligence, and investor materials. After regulatory approvals, management meets investors through education and roadshows. The syndicate collects demand during book building, sets the price, allocates shares, and supports trading after listing. In MENA, investor education and clear positioning are critical because liquidity, ownership structure, and macro sentiment can materially affect demand. While answering, focus on preparation, due diligence, equity story, valuation, regulatory filings, investor education, book building, pricing, allocation, listing, and aftermarket support, especially relevant to regional ECM execution. Question 10. Walk me through a sell-side M&A process from mandate to closing. A sell-side process begins with understanding the client's objectives and preparing materials such as a teaser, NDA, confidential information memorandum, financial model, and buyer list. The bank contacts selected strategic and financial buyers, manages initial interest, and invites first-round bids. Shortlisted bidders receive deeper diligence and meet management. Final bids are evaluated on price, certainty, timing, and conditions. Then the parties negotiate the sale agreement, secure approvals, and close. The analyst supports data, materials, tracking, and valuation throughout. Make sure to cover preparation of marketing materials, buyer list, teaser, NDA, CIM, management presentations, first-round bids, due diligence, final bids, SPA negotiation, approvals, and completion. Question 11. How would rising interest rates or currency devaluation affect a company's valuation? Higher interest rates usually reduce valuation because WACC rises and future cash flows are discounted more heavily. They also increase interest expense for floating rate or refinanced debt, which can pressure earnings and credit metrics. Currency devaluation depends on the business model. Exporters may benefit, while import-heavy companies face cost inflation and margin pressure. In a DCF, I'd update revenue, costs, CapEx, working capital, and discount rate assumptions. In comps, investor sentiment may compress multiples for exposed sectors. In your answer, discuss WACC, debt servicing, imported costs, revenue translation, inflation, margins, investor risk appetite, FX debt exposure, and how these assumptions flow through a DCF and multiples. Question 12. How would you estimate synergies in a merger model? I'd split synergies into cost and revenue synergies. Cost synergies are usually more reliable. Headcount rationalization, procurement savings, branch consolidation, or overhead reduction. Revenue synergies, such as cross-selling or new market access, are harder to prove, so I'd be more conservative. I'd estimate annual run rate benefits, phase them in over time, deduct integration costs, tax affect the savings, and test sensitivities. The key is not just identifying synergies, but assessing execution risk and whether they justify the premium paid. Be sure to mention revenue synergies, cost synergies, timing, implementation costs, tax effects, probability weighting, management guidance, benchmarking, and why synergy assumptions should be conservative. Question 13. Pitch me a MENA sector or company you would track as an investment banking analyst. I would track healthcare services in the GCC and Egypt. The thesis is supported by population growth, insurance penetration, medical tourism, and government reform. The sector also has fragmented operators, which creates consolidation potential for strategic buyers and private equity. From a banking angle, that can lead to IPOs for scaled platforms, debt raises for expansion, or M&A mandates. Key risks are regulation, doctor retention, reimbursement pressure, and FX exposure for imported equipment and supplies. While answering, focus on a clear thesis: market size, growth drivers, valuation relevance, transaction potential, risks, and how the idea could translate into an IPO, M&A, or capital raise mandate. Question 14. Why can a profitable company still run out of cash? Profit is based on accrual accounting, but cash depends on timing. A company can report strong net income while cash is tied up in receivables, inventory, or large capex projects. For example, if revenue grows but customers pay late, working capital can absorb cash faster than earnings accumulate. Debt repayments, dividends, taxes, and one-off costs can also drain liquidity. That's why I focus on free cash flow, cash conversion, and balance sheet strength, not just EBITDA or net income. Make sure to cover accrual accounting, working capital investment, receivables collection, inventory buildup, capex, debt service, dividends, one-off costs, and the difference between earnings and cash flow. Question 15. Tell me about a time you worked under pressure or caught an error in your analysis. In a university valuation project, I noticed our implied share price changed sharply after a late model update. I traced it to a working capital formula pulling the wrong year. I fixed the link, checked the surrounding formulas, and told the team before submission rather than hiding it. We revised the output and still met the deadline. The lesson was simple. Under pressure, I need to slow down, use checks, and communicate issues early. In your answer, use a structured example with situation, task, action, and result. Emphasize ownership, attention to detail, communication, deadline management, and lessons relevant to analyst work. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.